Singapore plans to borrow to fund major long-term infrastructure under the proposed Significant Infrastructure Government Loan Act, or SINGA. The projects will include new MRT lines like the Cross Island Line and the Jurong Region Line, as well as infrastructure to protect against rising sea levels. Up to $90 billion in new bonds will be issued to spread out the costs of these projects. And Deputy Prime Minister Heng Swee Keat says the approach is fair because payments are borne by the generations who will directly benefit from the improved infrastructure. Experts expect a healthy demand for these bonds given their current low interest rate environment, and they explain that people are likely to take their money out of banks and invest them in such bonds with more competitive returns. They expect the tenure for these bonds to range from 10 to 25 years. The lower interest rates also benefits the borrower.
A high credit quality, a high sovereign rating that Singapore has of AAA is that Singapore can actually tap the market at virtually zero real interest costs. And this is what the most of the developed countries are doing as well. So when the DPM made a statement that we should benefit from the low interest environment, I think it's effectively that where at least countries like Singapore, where liquidity will not be a challenge for investors given the sovereign rating, as well as the low interest rate environment works in our favor, we can actually raise long-term bonds at very low interest rates.
Now, borrowing to finance infrastructure is not new. The government borrowed in the 1970s and the 1980s to build the country's first MRT lines and Changi Airport Terminals 1 and 2. Economists add that this approach is more sustainable in the long term when compared to tapping on reserves, as there may be fewer recurring revenue sources that the government can tap on, since more recurring expenditure is being funneled towards healthcare and education. And they also warn that under the Constitution, tapping on the reserves should only be done under extreme circumstances, as seen during the pandemic.
If we were to touch on the reserve every time we need to fund an infrastructure, then the thing is that we will draw down our reserve very quickly. Do note that the biggest source of revenue in Singapore's fiscal position, the net investment return contributions, this is essentially the returns from investing our reserve. So if we keep on tapping on the reserve, we are running down our principal. That essentially implies that it will affect the future inflows of NRRC.
The most prudent way of funding that is through commercial loans that are available in the market. A cap of $90 billion, which has been put, becomes relevant, where we are tapping the bonds because it's cheaper and attractive source of capital, but we are not extending it so much that it won't be serviceable or will become a burden in future generations.